The U.S. Treasury market, long considered the bedrock of global finance and a quiet stabilizer for diversified portfolios, is reportedly facing unprecedented risks as its inherent stability may be more deceptive than previously understood. Analysts are warning that hidden leverage, coupled with a shift in Treasury funding strategy and declining liquidity, is creating a fragile environment where the world's safest asset could experience abrupt and disruptive repricing. At the heart of these concerns is the Treasury basis trade, a sophisticated strategy employed by hedge funds. This trade involves simultaneously buying cash U.S. Treasuries and selling Treasury futures, profiting from minuscule price discrepancies. To amplify these small returns into meaningful profits, hedge funds utilize very high leverage, often stacking large notional positions on modest price differences. While seemingly innocuous, this high leverage renders the trade inherently fragile. If funding costs spike, or if the spread, the basis, moves unexpectedly, these leveraged players could face mounting losses, forcing a rapid and synchronized unwinding of their positions. This vulnerability is particularly concerning because the size of the basis trade has reportedly swelled to an estimated $1.4 trillion, potentially double the size seen in March 2020. During that period, the Federal Reserve had to intervene with massive asset purchases to prevent a full-blown liquidity crisis in the Treasury market. Should a similar or even smaller shock occur now, a widespread unwind of the basis trade could trigger forced selling of cash Treasuries, further pushing prices down and yields higher, effectively amplifying any underlying market turmoil rather than cushioning it. Further complicating the situation is the U.S. Treasury's recent funding strategy. To contain near-term interest expenses, the Treasury has increasingly relied on issuing shorter-dated bills. While this saves on immediate borrowing costs, it leaves the government more exposed to volatility in short-term interest rates. More volatile front-end rates tend to coincide with larger swings in the basis, increasing the likelihood that leveraged players will be forced to deleverage simultaneously. This combination of a leveraged basis trade and a bill-heavy funding mix creates a dangerous feedback loop that could lead to higher long-term borrowing costs for the government, exacerbating the nation's already elevated fiscal deficits. Moreover, research suggests that the stock-bond inverse relationship, a traditional cornerstone of portfolio diversification, is fraying. Historically, bonds acted as a hedge against equity losses during crises. However, recent episodes have shown both stocks and bonds falling simultaneously, indicating that macro risks such as trade wars and fiscal deficits now impact both asset classes in sync, eroding the benefits of diversification. This breakdown means investors can no longer rely on treasuries as a reliable buffer during periods of market stress.